Listen carefully because what I'm about to share with you is going to sound absolutely insane until you see the evidence. Right now, at this very moment, we're witnessing the final coordinated attack on precious metals prices before the most explosive move in modern financial history. And I can prove it. You know that feeling when something just doesn't add up? When the price action on your screen contradicts everything you're seeing in the real world? That's not paranoia. That's pattern recognition. And the pattern we're seeing right now is identical to what happened right before every major precious metals explosion in history. Let me paint you a picture of what's actually happening behind the curtain while everyone's distracted by the price drops. The COMEX, the world's largest metals exchange, just lost over 37 million ounces of registered silver in less than 7 weeks. Think about that number, 37 million ounces. That's not normal market activity. That's not profit-taking. That's a run on the bank happening in slow motion while the mainstream media talks about everything except this. Here's where it gets interesting. While silver prices were supposedly falling during this period, physical metal was vanishing from the vaults at a rate we haven't seen since the last major squeeze. The registered category, the metal actually available for delivery, dropped from over 80 million ounces to barely 43 million. And here's the kicker. Commercial traders, the big banks that usually suppress prices, flipped to their most bullish positioning in years right before this drawdown accelerated. You want to know what that means? It means the smart money knows something. They're not just buying the dip. They're taking physical delivery and removing it from the system entirely. When you see that kind of divergence between paper price and physical demand, you're watching the endgame of a manipulated market. Let me take you back to a moment in history that rhymes perfectly with what we're seeing now. It's early 1980. Gold had been climbing steadily, but then something strange happened. In the final weeks before it hit its peak of $850, there was a vicious shakeout. Prices dropped hard. Weak hands sold. The media declared the gold rush over. And then, in a matter of days, gold absolutely exploded to levels that seemed impossible just weeks earlier. The people who held through that final shakeout made generational wealth. The people who sold at the bottom watched in agony. But here's what most people don't know about that period. The shakeout wasn't random. It was engineered. Large institutions needed to shake out retail investors before the real move began because they knew what was coming. They knew the dollar was in trouble. They knew inflation was about to spiral. They knew the Hunt brothers' silver squeeze was about to expose the fragility of the entire system. So they created one final moment of maximum pain to get weak hands out before the moonshot. We're in that exact moment right now, and I can show you why. The fundamentals have never been stronger for precious metals. Central banks globally are buying gold at the fastest pace in over 50 years. They're not buying paper contracts. They're demanding physical bars and taking delivery. China alone has been adding to its reserves month after month, building the largest gold position in its modern history. Russia has completely de-dollarized its reserves, converting everything to gold and yuan. Even countries that were traditionally dollar loyal are quietly diversifying into physical metal. Why? Because they see what's coming. The dollar's reserve currency status is under attack from every angle. The BRICS nations are building alternative payment systems. Saudi Arabia is accepting yuan for oil. The petrodollar system that's underpinned American financial dominance for 50 years is crumbling in real time. And when that system breaks, when the world loses confidence in dollar-denominated assets, there's only one place that capital can flow: physical assets, real money, gold and silver. Now, let's talk about the supply side, because this is where the story gets truly explosive. Silver production peaked years ago. The easy deposits are gone. What's left requires more energy, more capital, and more time to extract. Meanwhile, industrial demand is skyrocketing. Solar panels, electric vehicles, 5G infrastructure, every major technological trend of the next decade is silver intensive. We're talking about a metal that's being consumed faster than it's being produced, with above-ground inventories at multi-decade lows. The math is simple and terrifying for anyone short this market. If industrial demand continues at current rates and investment demand picks up even modestly, there literally isn't enough silver to go around. The COMEX vaults are already showing stress fractures. the London Bullion Market Association is seeing unprecedented tightness. Premiums on physical metal are diverging from paper prices in ways that signal a broken market structure. And here's the thing that should terrify anyone betting against metals right now. The paper market, the futures contracts, and derivatives that determine the price you see on your screen, that market is leveraged at ratios that would make a subprime mortgage broker blush. For every ounce of physical silver in COMEX vaults, there are hundreds of ounces of paper claims. It's a fractional reserve system built on the assumption that most people will never ask for delivery. But what happens when they do? What happens when the commercial players who've been net short for years suddenly flip long and start demanding physical? What happens when sovereign wealth funds decide they want metal, not contracts? What happens when the paper price diverges so far from physical reality that the entire pricing mechanism breaks? We're about to find out, and the answer is going to reshape the entire financial landscape. Let me share something with you that most investors don't think about. When you own physical gold or silver, you're not just holding a commodity. You're holding the only form of money that's survived every currency collapse in human history. Every fiat currency ever created has eventually gone to zero. Every single one. The dollar, despite its current dominance, is no exception to this rule. It's just a matter of timing. And the timing is accelerating. Look at what's happening with government debt. The United States is adding trillions to its national debt every year with no plan to ever pay it back. The only way out is inflation. Print more money, devalue the currency, and inflate away the debt. It's the oldest trick in the sovereign playbook, and it's happening right now in slow motion. But here's where it gets personal. If you're sitting on retirement accounts, savings, or any dollar-denominated assets, you're watching your purchasing power erode in real time. The official inflation numbers are a joke. Anyone who buys groceries, pays rent, or fills up their gas tank knows the real inflation rate is multiples higher than what the government reports. Your dollars are losing value every single day, and the pace is accelerating. Quick aside here, because this is important. If you're holding $100,000 or more in traditional retirement accounts, there's a strategy worth understanding. Gold IRAs allow you to hold physical precious metals inside your retirement account without triggering tax penalties. I put together a comprehensive guide on how this works. It's linked in the description below. It covers the mechanics, the custodians, the storage requirements, everything you need to know. Worth checking out if you're concerned about dollar devaluation and want to protect your retirement savings with real assets. Anyway, back to what's happening in the markets right now, because this is where the story gets even more interesting. The backwardation we're seeing in silver futures is unprecedented. For those unfamiliar with the term, backwardation means near-term contracts are trading at a premium to longer-dated contracts. In normal markets, the opposite is true. You pay more for future delivery because of storage costs and time value. But when a market goes into backwardation, it signals one thing: immediate physical demand is overwhelming available supply. This is the same signal we saw before the 2011 silver spike. It's the same signal we saw before the 2020 squeeze, and it's flashing red right now, brighter than ever before. The market is screaming that there's not enough physical metal to satisfy current demand, let alone what's coming. And what's coming is a perfect storm of catalysts that could trigger the largest short squeeze in commodity market history. Think about the setup. You have massive paper short positions held by commercial banks. You have dwindling physical inventories. You have surging industrial demand. You have central banks buying aggressively. You have geopolitical tensions driving safe haven flows. You have inflation expectations rising. You have dollar weakness accelerating. Any one of these factors alone would be bullish. All of them happening simultaneously? That's not just bullish. That's apocalyptic for anyone on the wrong side of this trade. Let me tell you about a conversation I had with a bullion dealer last month. This is someone who's been in the business for 30 years, who's seen every cycle, every squeeze, every panic. He told me something that sent chills down my spine. He said the current market feels exactly like early 2008, right before the financial crisis, when physical metal completely disappeared from the market for weeks. Premiums exploded, delivery times stretched to months. The paper price meant nothing because you couldn't actually buy metal at that price. He's seeing the same warning signs now. Mints are struggling to keep up with demand. Wholesalers are rationing inventory. Premiums are creeping higher despite flat or falling paper prices. The disconnect between paper and physical is widening every day. And when that gap gets wide enough, when the cognitive dissonance becomes impossible to ignore, the paper market breaks. And when the paper market breaks, when the price discovery mechanism fails, when the COMEX defaults or suspends trading or changes the rules to protect the shorts, that's when the real price discovery begins. That's when we find out what an ounce of silver is actually worth in a world where everyone wants it and nobody wants to sell. History gives us clues about what that price might be. In 1980, silver briefly touched $50 an ounce. Adjusted for real inflation, not the government's fantasy numbers, that's well over $500 in today's purchasing power. Some analysts argue it's closer to $1,000 when you account for monetary expansion and the destruction of the dollar's value. But here's the thing. The 1980 spike was driven primarily by investment demand and the Hunt brothers' attempt to corner the market. Industrial demand was a fraction of what it is today. The derivatives market didn't exist in its current form. The level of paper leverage was nothing compared to now, and global debt levels were a tiny fraction of today's astronomical numbers. In other words, the setup today is exponentially more explosive than 1980. The fundamentals are stronger. The supply deficit is larger. The monetary backdrop is more favorable. The geopolitical tensions are more severe. And the paper market is more fragile. So, when people ask me where silver could go in the next major move, I tell them to stop thinking in terms of the old highs. This isn't about retesting $50. This is about discovering what silver is actually worth in a world where the dollar is losing reserve status, where industrial demand is insatiable, where investment demand is just beginning to wake up, and where the paper market structure is on the verge of collapse. Some of the most respected analysts in the space are talking about triple-digit silver, not as a wild speculation but as a mathematical inevitability based on supply and demand fundamentals. When you run the numbers on industrial consumption, investment demand, and available above-ground supply, you get to a place where current prices are not just undervalued, they're absurdly, impossibly undervalued. But here's the catch. To get to that revaluation, to get to that price discovery moment, the market has to break first. The manipulation has to fail. The shorts have to capitulate. The paper market has to give way to physical reality. And before that happens, before the dam breaks, there's always one final shakeout. That's where we are right now. This is the shakeout. This is the moment of maximum pain designed to get weak hands out before the real move begins. And I can prove it by showing you what the smart money is doing while everyone else is panicking. Look at the commitment of traders' reports. Commercial traders, the big banks that have been net short for years, have reduced their short positions to levels we haven't seen in over a decade. They're not just covering. They're flipping long. They're positioning for a move higher, not lower. Meanwhile, the small speculators, the retail traders, are getting shaken out at exactly the wrong time. This is not a coincidence. This is how markets work at major turning points. The professionals accumulate while the amateurs capitulate. The institutions buy when there's blood in the streets. The smart money positions before the move, not after. And right now, the smart money is screaming that we're at a major inflection point. Central banks aren't buying gold because they think it's going lower. Sovereign wealth funds aren't taking physical delivery because they're bearish. Commercial traders aren't flipping long because they expect prices to collapse. They're positioning for what comes next. What comes next is the moonshot. The move that makes 2011 look like a warm-up. The repricing that reflects decades of monetary abuse and market manipulation finally coming home to roost. The moment when paper promises give way to physical reality and the true value of real money is rediscovered. But to capture that move, to be positioned when it happens, you have to hold through this final shakeout. You have to ignore the noise. You have to trust the fundamentals. You have to understand that price manipulation only works until it doesn't, and we're approaching the moment when it doesn't. Let me share one more historical parallel that should give you confidence in what's coming. In 2008, during the financial crisis, gold initially sold off hard. Everyone needed dollars. Margin calls forced liquidation of everything, including precious metals. Gold dropped from over $1,000 to below $700 in a matter of weeks. The gold bugs looked foolish. The mainstream media declared the gold bull market dead. And then something remarkable happened. Gold bottomed, reversed, and went on the most powerful bull run in its history. It didn't just recover the losses. It exploded to new all-time highs, eventually reaching $1,900. The people who sold at $700, who capitulated at the bottom, who believed the mainstream narrative, they missed the entire move. The people who held, who bought more, who understood that the crisis was bullish for gold, not bearish, they made fortunes. We're in that exact moment right now. The crisis is here. The monetary system is breaking. The dollar is losing its grip. The paper markets are showing stress fractures. And precious metals are being shaken out one final time before the real move begins. The question is, are you going to be one of the people who holds through this shakeout? Are you going to be positioned when the dam breaks? Or are you going to capitulate at exactly the wrong time and watch the moonshot from the sidelines? Because make no mistake, this move is coming. The fundamentals guarantee it. The supply and demand dynamics guarantee it. The monetary backdrop guarantees it. The geopolitical tensions guarantee it. The only question is timing, and all the signals suggest that timing is now. The COMEX inventory drawdown is accelerating. The backwardation is intensifying. The commercial positioning is the most bullish in years. The central bank buying is relentless. The industrial demand is insatiable. The paper market leverage is at breaking point. Every single indicator that matters is flashing red. This is not the time to panic. This is not the time to sell. This is the time to hold fast. This is the time to add to positions if you have the capital. This is the time to ignore the noise and trust the fundamentals. Because what's coming next is going to be spectacular. The final shakeout before the moon is always the most painful. It has to be. That's the whole point. Maximum pain creates maximum capitulation, which creates maximum opportunity for those who understand what's really happening. The institutions know this. The central banks know this. The commercial traders know this. And now you know this. So when you see the price drops, when you feel the fear, when the mainstream media tells you precious metals are dead, remember what you learned here. Remember the COMEX inventory drawdown. Remember the commercial positioning. Remember the central bank buying. Remember the supply deficit. Remember the monetary backdrop. Remember that every major move in history was preceded by a final shakeout that looked exactly like this. Hold fast. Stay strong. Trust the fundamentals. Because the moon is coming, and it's going to be glorious for those who had the courage to hold through the final shakeout. The greatest wealth transfer in modern history is about to begin, and precious metals are going to be at the center of it. Don't let them shake you out right before the main event.